Well, hello everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. Got a chart of the SPY. Let me change it to the S&P 500, and you can see here's the 2016 low, and this has been the run up since the 2016 low. Let's zoom in on a little more recent action. You can see that this week we got to close below the low of the high day. Okay, so here's the high, in this case the high week. So the high week is right here, right? And the market closed below the low of that high week. Now, to me, this is always a good good signal. I mean, if you use this simple method, and we've covered it in here before, it's a good way to stay in with the trend. Now, does it mean that the market couldn't come down here and then turn around and bounce back up? No, it doesn't mean that. That certainly could happen. But if you go back and you back test something simple like this, you'll find that it keeps you safe and also keeps you in the market when you need to be in the market making money. Okay, so I just thought I'd point that out. It's actually for the simple system that I use, it's actually a sell signal. Right there is a sell signal. So I just wanted to point that out. Secondly, let me zoom back out for a second, and let me delete some of this stuff so we don't have as much stuff on here. But I want to do I'm going to do a Fibonacci retracement of this trend and then a Fibonacci retracement of this trend, and we're going to look at some similar attributes. Okay, so let me zoom in a little bit. Let me go down here to my Fibonacci tool, which is right here, and let's grab the high. So the high is right there, and we'll go down to the low, which is right there. I can get it to stick. There we go. And one of the things you can see is that we retrace to the penny, 78% of this first move down. So let me delete this so I don't have too much on the screen. And then what I want to do is I want to do the same thing and look at this trend down and see how much of it we have retraced. A little bit, almost 100% of it. But certainly got over the 78%. And normally, so let me just talk about normally. My experience is once you get over really 62%, that, and I know that doesn't leave much to make money on the upside, but usually it'll retrace 100% of this previous high or this previous move down. Okay, so it's not clear to me at this point whether I should expect the S&P 500 to kind of trickle its way up here into new highs, or which would be it would be new highs of this trend. But it wouldn't take out these highs, right? So, but sometimes you can finish short here, and I'll just show you kind of not a famous example, but one that Elliott Wave pointed out. This is gold as it ran up to its highs in 2011. It sold off, and then chopped sideways in this rather complex pattern, went up. Did not make a new high, okay? Now, it eclipsed this high, but not this one. And then, boom, sold off dramatically. Now, excuse me. Here's our market here. Now, this is the Dow, but it looks the same as the S&P. Same kind of thing. It sold off, chopped sideways, went up higher, but did not take out the old high. And, so we could be setting up for something that looks like, this that we saw in gold. So I just wanted to show you that. And of course, when you have a big move like this is where the psychology really works on you. It's like right here, man, I wish I'd have sold back here when I was nervous, and well, I'm going to hang on because I'm closer to the bottom. It's probably find support off this pivot right here, and then it goes, way down, and then it rallies a little bit back to the underneath level of support, and you say, oh, okay, well, that's it. It's going to keep going up, and then it sells off again, and then about the time, you've been fooled 3 times, right here is when you finally get out, right before there's, a significant rally. So you just have to be aware of the psychology. And I tell you what, as rational as you think you can be, it is still so hard to make those decisions. And I don't know if you have any experience with that, but it sounds a lot easier than it actually is. It's one of those type things. All right, let's look at. Let me close that. Let's look at some of the other markets on my list here. Let's look at the volatility index. Now, volatility rose a little bit, which you would expect because the market was down, but it looks like the range was quite a bit larger. So that could be signifying the end of this down move and the end of the up move in the S&P 500, but we'll just have to wait and see. All right, let's look at treasuries. Let's look at the 10-year. The 10 years, as I've said many times, is probably the most important yield in the market. So the 10-year could be through pulling back, but I don't think so. It feels like to me, with some sort of market sell-off, we should get the 10-year pulling back down into this area around 2.6%, which would be a 62%. I'm sorry, no, that's not right. I was about to say something that was inaccurate. If we wanted to measure, let's back up a little bit. If we wanted to let me get rid of this. This is not pertinent to what we're discussing right now. Let's do a retracement of this move right here, from here all the way up to here. See, so far we haven't even pulled back. See, the 38% retracement would be here, so the 62% would be down here around 2%. So, my experience is it's got to at least go to the 38% if this wave one here is complete. So maybe look for the 10-year to rally a little bit and then sell off, and maybe sell off as much as all the way down into this area around 2%. Let's look at the short-term treasury. Obviously, if we're expecting a sell-off in the 10-year treasury, you're going to see some of that show up in the shorter-term treasury market, which it looks like this trend has been flirting with the end for a while. So I wouldn't be surprised to see this pull back a little bit, maybe to some level off of this support back here before it rallies back up. So looks like all the measures are kind of lining up to a single coherent story, and you kind of want to see that. That's just weight of the evidence stuff. When you're looking at the market, you want to see, as you're checking through all your little checkpoints before you buy or sell, you look at the weight of the evidence. All right, here's Germany. You can see Germany now is definitely weaker than the U.S. market. We had a big gap down, big sell-off, and a little bit of a run back up. But Germany definitely looks weak. You've got Japan, looks a little weaker than our market. And let's see, the United Kingdom was, I think, a little stronger, but let's see. Some of the emerging markets, of course, these are not emerging markets, but they're closer to the emerging markets than, let's say, we are. And they got, some of them got rang up here recently. So Europe and Japan and some of those countries could have experienced a little bit of selling because of that. All right, let's see. What do we want to look at now? I think that's all I want to look at in this list. Let's switch over to the TOS list, Thinkorswim list, and go to charts. And here's a chart of the S&P 500 since the 2016 low. You can see I'm counting 5 waves here: 1, 2, 3, 4, 5. Now, it's possible that this is 4 because this looks like the kind of pullback you would need in order to match this pullback. But as I've said on here before, the internals, the advanced declines, the breadth, those kinds of measures have not been that great on this run up. So that would indicate to us that we are we've completed wave 5 and that we're in some sort of wave 2 after our initial move down. So at a minimum, you're going to see something below the 2016 low, probably in that 1700 area, maybe 1650. So we'll just wait and see. And like I said, I think I've already mentioned this, but you can clearly see that we've closed below the low of this candle right here, and this is a weekly chart, so those are usually pretty good symbols. Another thing I like to look at is I'll go to a 4 hour. I don't have the, let me see if I've got it on the profit charts. I think this is a hide studies. Let me just add a study real quick. Let's see, which one do I want? Price plus MACD moving average. Yeah, so this shows it pretty good. One of the things you'll notice, and you can go back and look at this, you can go way back and look at this, but on a, let me see if I can get a 4 hour chart. This may not have a 4, nah, this doesn't have a 4 hour chart. Well, what I was going to show you is that the MACD, once this line crosses, a pretty high percentage of the time it falls significantly down to a new low. Now, if this doesn't come all the way down here, then this has potential for just bouncing and going up, which is what it did here. But MACDs and RSIs, they can. You just need to start noticing where they bounce with respect to where the market hits a major bounce. So notice here, made a low and then ran up and then made a lower low, and so did the market, made a lower low. But then as soon as it crossed right here, you should probably be looking at getting in, right? Same thing right here. It kind of bounced, it crossed. You really don't know which one it's going to start going down on, but notice the crosses or the crossover is unique to a change in trend. And so sometimes it's easy, it's good to look at just to kind of give yourself a place in the trend to look at. Now, these can overbought and oversold can be overbought and oversold for long periods of time, especially if you're in a wave 3. So it doesn't work all the time, but the time that we're in a wave 3 is really not very often. So it should work, let's say 75% of the time. All right. Let's go back over to the Thinkorswim charts. Let's get off that. We don't need to be on a 4 hour. All right. Let's look at the Euro US dollar. If you zoom in on this right here, you can see that The dollar is likely, I mean, the U.S., the euro is likely made 5 waves against the euro, so we're expecting this to rally a little bit, maybe in here to 120-ish, and then we should expect it to roll over again. In fact, let's just see what the Fibonacci is on that. If you can buy or sell rather near that 120, maybe a little higher, I think that's a great place to enter. Let's see what that works out to be. Yeah, so right in this area, right in here, around 1215, 1250. You might see the market get back up into. I tell you what, let's put a box on there. Let's modify this box because it's already no longer useful. So in all likelihood, we're talking about the market getting back up into this area around 62%. So, make sure you're in gear with that. Make sure that your plan matches up to that. Same thing with the ES. So we got a low, we ran up, made a low, but not a lower low, a higher low. We keep making higher lows, which is good for the bulls. But this activity recently is likely not good for the bulls. So you can see on the E-minis, we even sold off more. So the E-minis were weaker than the index. All right, let's look at gold. So as you can see, gold has broken this little trend line here, and like I've said, I'm really not comfortable with where gold is right now. And I mean, it could literally pull all the way back to here and then bounce, or it could just bounce right here and and end up somewhere in here before it rolls over and goes down. So I still can't see what I need to see in gold. The US dollar CAD, has been really strong. I think we're come to an end of that, as you can see here by the way this overlapping wave action looks. In fact, this kind of at this point looks like a 2, but this definitely looks like a 2. So I would think this we're looking for bullish stuff here happen on the US dollar CAD. Now the Euro USD, it may be really short-term bullish, like for the next 3 weeks or so, but then we should get a signal to sell the euro, and the euro is likely to come down here, around parity before it's all said and done. So, not sure what else to show you in here. There's really nothing interesting. The British pound, US dollar. I mean, we looked at that. It looks kind of like it wants to bounce. The thing to recognize probably in the market right now is you gotta be careful. In this market of stocks, because if this is a wave 2 that's been forming for who knows how long, let's go back to then it's also likely to be the mother of all sell-offs once it gets going, gets some momentum and starts heading south. So just be careful. If you're still in bond funds, I think that's okay for a little while. Especially if we get a market sell-off, there's going to be some temporary money running into bonds, which should drive things up and give you a good place to go ahead and get out, the market. So anyway, that's about it for this week. Thanks for tuning in, and start sending the links to your friends and family members, and let's keep everybody safe financially through what is likely to be, a pretty tough storm. I think I showed you guys last week, the "You Are Here" picture, and maybe we'll show it next week, just to kind of keep people's minds in the forefront of what's potentially at risk here. Okay, and then once it starts happening, we can talk more about, because everybody will be speculating, why is this happening? And of course there'll be a whole bunch of nonsense about Trump's a horrible president and that's why it's happening, and the trade thing, and that's why it's happening, and those could be catalysts, especially the trade thing. But the bigger problem is just debt. We've got an economy that's just got a tremendous amount of debt, both consumer debt and public debt. And when you have that much debt, it's very difficult to invest in new technologies and new advancements. In fact, it tends to make all areas of the economy a little bit more conservative. If you think about it, if you have a bunch of debt, how likely are you going to go sign up for more debt, right? To invest or to kind of back some new venture or technology. Whereas if you had your Apple and you got $170 billion in the bank, yeah, it's pretty easy to take on something new because you're feeling comfortable, you're feeling financially secure. And I think of course Apple is the exception. The vast majority of the companies in the S&P 500, for example, have massive amounts of debt. They're highly leveraged companies, and they're ultra conservative, and they don't do the things that the type of things that are going to lead to the next major bull market. So in fact, those things typically come from you look at all the big advancements, they've all come from new startups, entrepreneurs, people like that. They don't come from GE or ABB or Siemens or companies like that. They just don't do that. Those companies kind of sit on the sidelines and they wait to try to snap those companies up. So anyway, like I said, once the selling gets started and there's not much to do except watch it go down, we can talk more about the types of problems we have in our economy and maybe start sharing some information like that. So, all right, everybody, I hope that's good. I hope you're feeling comfortable about where you're at. If you're not, feel free to comment on the video, and I will respond just as soon as I can. Other than that, have a great weekend. Let's see, the weekend after next, not this coming weekend, but the next week, it's going to be Independence Day. It's always one of my favorite holidays. It's hotter than Hades down here in Texas, but it's still a fun time, and got good memories from when I was a kid. Used to go camping with my grandparents over Independence Day weekend, and we used to have bottle rocket wars and stuff like that. It was a lot of fun. So always love Independence Day, and hope you guys share with that. All right, take care, everybody. We'll see you next time. Bye bye.